Okay, this is a paper called Profitability of Momentum Strategies in the International Equity Market, written by Kalok Chan, Aladdin Ahmed, and Wilson Tong. It was published in the Journal of Financial and Quantitative Analysis in June of 2000. So let's jump into it. So numerous recent studies found that stock returns can be predicted based on their past price history, and that these types of strategies could lead to abnormal returns. In particular, Jagadish and Titman back in '93 documented that there is momentum in stock prices where you could earn 1% per month over the next 3 to 12 months. And there's two possible explanations for this. Number one, stocks could possibly underreact to new information, and that was noted in a 1996 paper by Chan, Jagadish, and Lakanishak. It particularly happens around earnings announcements and may also depend on analyst coverage. Another reason this may happen is that investors might flock together, and so there have been several studies about herding behavior. And several prior studies have found that mutual funds and pension fund managers tend to buy past winners. And those studies were primarily done in the U.S. markets, but there are also several studies around this in the international markets as well. For example, in the European markets as well as the emerging markets. But a few researchers have found that emerging markets aren't as profitable as maybe other studies had found. And so in this paper, the authors hope to include global equity markets and contribute to the literature like this. And so first, they're going to implement the momentum strategies based on individual stock market indices. And in doing so, they hope to determine whether these momentum strategies are useful for country selection. And next, the authors are going to see how these momentum strategies are affected by exchange rate movement. And so in doing so, they hope to find the interdependence between the currency markets and the momentum strategy. And third, they hope to investigate whether trading volume information affects the profitability of momentum strategy. In particular, technical analysts have typically used volume data to provide information about future stock price movement. And so we hope to find whether low volume may signal an underreaction to information, which might lead to a profitable momentum strategy. And there's been a lot of research about this where trading volume does contain information about future stock prices. In particular, high volume stocks tend to have price reversals, whereas low volume securities experience price continuations. Also, stocks whose volumes are unusually large tend to experience large subsequent returns. And others have found that past trading volume predicts both the magnitude and persistence of future price momentum, and that price momentum strategies tend to work better among high volume stocks and intermediate horizon. And so all of those studies were done on individual stocks. However, this particular study will deal with stock market indices. And so the paper will look like this. Section 2 will present the framework of analysis of momentum strategies. Section 3 presents the empirical results. Section 4 presents robustness tests. And Section 5 concludes the paper. So let's take a look at Section 2, analysis of momentum strategies, and Section A, basic momentum strategies. So the way they're going to form their momentum portfolios is to weight these securities by their past performance relative to the average performance of all the assets that's being considered. However, this strategy will invest in stock market indices rather than individual stock. So this strategy can really only be implemented by investors who have access to international markets as well as short selling. And so this study was done from the perspective of a U.S. investor. So there could be a number of equity markets in the period, and the profitability will have to be calculated by converting the profits into US dollars if the foreign market is traded in a different currency. And so the portfolio weights will also be determined by the exchanged return. And so when determining the returns, the return of the overall index will be the index's return in the local currency plus the exchange rate return. So the sum of these two will get us to the US dollar return. And so what we have here is a weighted average where the index is weighted by its US return minus the average return over all of the indices. So an index that has a higher return than the market will get a higher weight than an index that has a lower return than the market. And this market return is the average return, US dollar return of all of the indices that are in the population. And so the philosophy here is that the investor will go long the past winner countries and it will go short the past loser countries. And so the profit of this strategy is basically just going to be the weight of each index times the return of that index and the sum of all of that. And so this is a zero cost portfolio, which would mean you can go long and short securities. So the total weight when you sum them all together should equal zero, because some of the weights are positive, some of the weights are negative. So the authors have also incorporated another metric which can be interpreted as the per period profits for every dollar invested in the long or short position for the arbitrage strategy. And it could also be interpreted as the difference in per period returns between the winner and loser portfolios. Okay, so let's look at section 2B, the decomposition of momentum profits. And so here they want to decompose the profits into the equity component, the currency component, and some interaction components. And so you remember that the dollar return equals about the local currency return of the index plus the return on the currency exchange. So then adding in the currency exchange to the prior formula that determined the weights, they've broken out this past return piece into local currency plus the exchange rate minus the local market return plus the exchange rate divided by the number of securities. It's the same formula as was before here, only now we're adding in the effect of the exchange rate. So basically, through a number of algebraic determinations, they found that the profitability of the momentum strategy can be broken down into 4 components. So the first component reflects profits due to the predictability of returns based on the prior returns. And this component is positive if the past returns of that index perform better than the average of all of them and is expected to rise further in the holding period. And the other components are similar to that one. The second component reflects profits due to predictability of exchange rates based on the prior equity performance. The third it reflects profits due to the predictability of equity returns based on the past exchange rate profits. And the last component reflects the predictability of exchange rate returns based on the past returns of those exchange rates. Okay, so let's look at section 2C, market capitalization weighted momentum strategies. So in the prior sections, the individual securities were weighted according to how much they had outperformed the world market. So here, in order to overcome a few constraints such as the securities being too small or in illiquid markets, we've weighted the portfolios according to their capitalization. So in this equation, the capitalization component is H, which is multiplied by the return over the average of all of the population. So then each of the components of the portfolio is weighted according to how large that market is. And since it's a zero-cost strategy, the total of the weights will equal 0, since some markets are going long and some markets are shorted. Okay, so let's go down to Section 3, Empirical Results, and Section A, Data. So they've obtained the equity market indices for several different countries. And Table 1 lists all of those countries as well as the indices and the sample period. So let's take a look at Table 1. We have a lot of different countries here and the applicable index, as well as the time period that they studied. Looks like all of them are from January 1980 to June of 1995, except a few that are off a year or 5 years, so all around the same time period. And so we have 9 from the Asia Pacific area, 11 from Europe, 2 from North America, and 1 from Africa. And so all of these indices are in US dollars, and volume measures are accumulated for most of the countries except 6 of them. And so they note that the countries work in different time zones, so there may be kind of a difference in time periods, but we're working off of weekly data, so that's not really a big concern. And so for the evaluation of portfolio formation period, a week begins on Wednesday and ends on Wednesday, but for the holding period, a week begins on Thursday and ends on Thursday. And they did this so that the evaluation period ends before the holding period starts, and so taking into account time zones, there's really no chance for overlap. Okay, so let's take a look at Section 3B, Profits to Momentum Strategies. And so we're structuring the portfolios like we discussed earlier in earlier section in the paper, where we're going long the winner countries and shorting the loser countries. And the portfolio weights are weighted according to their past returns over the average past returns over all of the indices. And we're going to use different holding periods, which they designate as the variable K. And K could be 1 week, 2 weeks, 4 weeks, 12 weeks, or 26 weeks. And the profits are calculated as we determined before, just the sum of the weights times the returns. And those returns are also decomposed as we into the 4 different components like we discussed in a prior section. Let's take a look at number 1, the sample period. All this data is going to be shown in Table 2, so let's see if we can find Table 2. Here we go, Table 2. So what we have here is in the first 4 rows are the 4 components, the return that we calculated or we discussed there, and then here's the total return for each of the time periods. So K equals the holding period equals 1 week, 2 week, 4 week, 12 week, 26 week, and so here we can see. Okay, so the first thing we note is the total average profit here is about 0.0024 cents for the first week, and or for holding period 1 week, and for 2 weeks it's 0.012997 cents, and for 4 weeks it's 0.020047 cents on. And based on the aggregate investment as well as the time period, down here we have the weekly return which can basically be interpreted as how much was the difference between the winner or the return of the winners minus the return of the losers per week. So one way to look at this is if this strategy were employed and held for a 4-week period, then the investor would earn 0.25% per week over that holding period. So over the whole month, the investor would earn an entire 1%. And all these strategies or holding periods are statistically significant, where these are over 2 standard deviations. So it looks like holding for 1, 2, or 4 weeks seems to be the best strategy, and then the returns start to fade off as the holding period is longer. Also to note, when breaking down the 4 components of the return, it seems like out of the 0.0024 cent in profit, 0.0023 were due to the first component, which predictability of equity returns based on past equity returns. The other components related to, for instance, the exchange rates and such, had a very negligible effect on the total profit. And it looks like the investors also do a bootstrap simulation in order to eliminate the serial correlation and the time series, and they come to the same results with 1 week, 2 week, and 4 week periods showing significant profits. Okay, so let's look at part 2 of this section, and it's about the post-1905 period. And so if momentum strategies are due to market segmentation, then we would think that momentum strategies would be less profitable once people are more easily able to access that market. And so in the 80s and 90s, a lot of restrictions have been removed. So we're going to take a look at the post-1985 period to see if that had an effect on the momentum profits. And so table 3 has the results of that test. So let's look at table 3. So just taking a look, first glance, this table doesn't look a whole lot different than the previous table. The profit looks to be about the same, as well as the percentages and the T statistics. So the component related to the predictability of the equity piece due to past equity returns seems to be about the same percentage of the overall profit, and is actually more significant. So we could say that in general, the post-1985 period didn't change the momentum profits that were earned previous to that, and that maybe market segmentation is not the cause of momentum profits, or doesn't contribute to it. Okay, so back to section 3, or 3 of the section, adjustment for individual countries' profits. So here we're going to determine if the momentum profit earned after adjusting for the world beta risk. So here we'll take the profit that's normalized by the aggregate investment, and we regress it across the standard CAPM formula, but with a world beta risk factor. And so this alpha figure would determine the excess profits relative to risk. And so they do this in the post-85 period so that all the countries have data observations. So in table 4, they display the results of this, and they only display the alphas. So let's take a look at table 4. So the first thing we note is that in the 1 week holding period, the alphas are pretty small and negligible for all the countries, and all the T statistics aren't large enough to reject the null hypothesis that there are no profits. So you can consider all these to basically be zero. However, as the holding period gets larger, we have larger and larger profits and T statistics. In the 2-week and 4-week period, most all of the alphas are positive. 19 of the 23 in the 2-week holding period are positive, and 17 of the 23 in the 4-week period are positive, and those T statistics are significant in most cases. However, in the 12-week and 26-week holding periods, those abnormal profits disappear and they become insignificant. So we could say that simple beta risk is the source of abnormal returns in the 12-week and 26-week periods, but holding the momentum strategy for 2 weeks or 4 weeks, the beta does not explain those returns. Okay, so let's go back up to table 3C, or section 3C, profits to market capitalization weighted momentum strategy. And so here we're going to weight the country's indices by their market capitalization. And so they note that about 75% of the world market is composed of the US, Japan, UK, France, and Germany. So those will be the largest components to the returns of the momentum strategy. And so the returns of the other countries won't largely affect our returns here. And if it's the case that momentum profits arise from small and illiquid markets, then what we calculate here may be unprofitable because the largest portion of the returns is going to come from the largest companies or countries. So table 5 reports the profits from the capitalization-weighted momentum strategy. So let's take a look at table 5. So here we see the weekly return percentage is a little bit smaller than it was in the prior portfolios that were built that were not capitalization weighted. And we can see that these profits are somewhat statistically significant for the shorter holding periods. And they've split it up between the loser portfolio and the winner portfolios, and then sum the two together for the strategy. For instance, this is the return of if you had shorted the loser portfolios, and this is the return if you had gone long the winner portfolios, and then this is the sum of those two returns. We can see for all holding periods the winner portfolio does well and statistically significant as well. The loser portfolio in the later holding period weeks starts to lose money. Okay, so let's go back up to table 3D. Effects of trading volume on momentum profit. So in this section we're going to examine the role of trading volume in momentum strategies. So as we discussed earlier, there's a lot of studies and papers that find a correlation between trading volume and short-term returns. For instance, a few researchers have found that traders who use volume do better than traders that do not. Some others found that variations in the volume are due to liquidity traders. And so it was found that price changes accompanied by large trading volumes tend to be reversed. Other investors have analyzed the combat between uninformed investors and informed investors. And they find that if prior high returns accompanied with high volume are due to private information being known by informed investors, then those returns should persist into the future where uninformed investors learn. But if high volume is due to non-informational reasons, then the high realized return will probably be reversed in the future. Other studies corroborate this, where high transaction securities experience price reversals, while the returns of low transaction securities are positively autocorrelated. So, since the predictability of short-term returns might be affected by trading volume, we're going to look at some volume information here and see if it affects the momentum profit. And so they take each of the equity markets and rank them according to their lagged trading volumes. And so it looks like they rank the volume as high if the most recent period volume is higher than the previous period before that, low vice versa. So table 6 reports the volume groups, and remember they didn't have volume data for 6 of the countries, so there's only 17 countries listed in table 6. So let's take a look at table 6. See if I'm able to rotate this. Okay, so let's take a look at this table rotated. Okay. So the first thing we notice is that the high volume section here, when compared to the low volume section here, the high volume portfolios outperform their accompanying holding period low volume portfolios. So, except for the 26-week column, but the 1 week, 2 week, 4 week, 12-week columns all outperform the low volume. So from that we could say that price continuation is stronger when accompanied by high volume. So that would go against the conjecture that momentum profits occur due to the underreaction to information due to insignificant trading. Okay, so let's take a look at section 4 now, where we dive a bit deeper into what this means. Okay, so here's section 4, robustness tests, with section A, non-synchronous trading. So one cause of momentum profits may be the presence of non-synchronous trading. And so that's basically just the effect that the different indices trade at different times and have different volumes, and they may incorporate new information in their prices in different times, and so it could flaw the analysis by assuming that all of them have a single cutoff when we're trying to calculate returns. So to mitigate that effect, we're going to do we're going to lag a week between the time when the portfolios are determined and when we actually invest in those portfolios. So table 7 reports the results of this. So let's take a look at table 7. And so except for this 1 week lag, all of the other, except for this 1 week holding period, all of the other week holding periods are less than the returns from the prior table that didn't have the 1 week lag between formation and implementation. And they're all statistically significant, and therefore not all of the momentum profits can be explained by non-synchronous trading. Okay, so let's go back up to 4B. Exclusion of emerging markets. So it looks like a significant portion of the momentum profits comes from emerging markets, and that was found in prior studies as well. So to test the momentum strategies on just the low, more liquid markets, we're going to exclude 6 of the countries that are from the emerging market, and table 8 reports those results. So let's go down to table 8. So this is similar to the prior tables. Here we can already see that the profit is a lot smaller than the prior table that included the returns of the emerging market. If you remember from the prior tables, the 4-week return was 0.25%, but here it's only 0.1%. Okay, so let's go back to section 4B. Excuse me, we're on section 4C now. Different beta in the up and down market. So the thought here is that maybe just a single beta is not adequate for calculating the risk-adjusted return. So we will have a regression that takes into account the bull and bear market. So here we have the return of the momentum portfolio minus the risk-free rate. And so what we have here is the same equation before. We have the alpha plus a market beta term plus an error term. But here we have a dummy variable. This D here is equal to either 1 or 0, depending on if the MSCI return is positive at the time of the portfolio formation. Then this term will be 1. And if it's negative at the time of portfolio formation, then this term is 0. So if a bull market, then this term will be 1, and it will keep this market risk term, and then it will do away with this term because there's a 1 here, so 1 minus 1 is 0, and make all of this be 0, and vice versa. So in a bear market, this might be 0, and so this term will be kept. And so we have the results in Table 9, so let's take a look at Table 9. Okay, so here we have Table 9, and this is going to be, all these results are going to be the winner portfolio minus the loser portfolio. And based on that regression we just talked about, here's the alpha term. So we see there's some abnormal returns here. And we also have the coefficients in the bull and the bear markets. And then down here, so I have it split up between high trading volume and low trading volume. And so in the bull market, we see that except for the 1 week holding period, all of the betas for the market risk are positive, which suggests that the winner countries have higher betas than the losing countries in an up market. And in a down market, since these coefficients are negative, we could say that during a bear market, the winner portfolios have a lower beta than the loser portfolios. And so adjusting for these betas in the different markets, after doing that, our alphas really are close to 0, and all of the holding periods other than the 2 week holding period are statistically insignificant. So we could say that the betas in the up or down market pretty much fully account for the return of the momentum portfolios. So let's take a deeper dive into the high trading volume versus low trading volume. So we see in the low pass trading volume column that the alphas are close to 0 and their T statistics are very small. So we could say that the risk-adjusted returns are generally insignificant after accounting for the betas in the bull and bear market. However, for the high pass trading volume section, the first 2 columns of the 1 week and 2 week holding periods are highly significant abnormal returns after adjusting for these risk betas. Therefore, even though the betas could fully explain the returns with low pass trading volume, they're unable to explain all of the profits when there's high pass trading volume. Okay, so let's sum this up with a conclusion. So the authors examine the profitability of momentum strategies based on past returns of country indices from global equity market. They found evidence for statistically significant momentum profits, especially over very short-term holding period. And they found that the majority of this profit came from price continuations in the individual stock indices and not necessarily the exchange rate. And they also found that the profits can't be completely explained by non-synchronous trading or confined to emerging markets, but the abnormal returns do somewhat diminish after adjusting for these items. What was interesting to find, though, is that higher volume, when it accompanies these momentum strategies, produces higher profits. And so this will mean that return continuation is stronger following an increase in trading volume. And this seems to contradict some other hypotheses about underreaction and price reversals, but it is consistent with other theories like the herding behavior. This study also contradicts another one that found price changes accompanied by a higher trading volume tends to be reversed in the following period. And the difference there could be just that this particular study involved international indices of different countries, whereas the previous study was individual securities in the U.S. market only. And the difference between the relation between trading volume and price continuation being different between individual stocks and an overall market could be done in future studies or explored in future studies.